Hello friends, welcome to learning sessions, and today it is the 10th day related to the bank financial management classes in 15 days series. And further we are going to cover the most important thing in module C, that's actually related to the treasury products. So whatsoever the different type of treasury products we are going to cover in this particular video. And if I have not gone through the previous lectures, you should be watching those particular videos on YouTube only. Those are actually available on YouTube only. And further, when so basically release those videos, we go online. These videos are available just for first 24 hours free of cost, and after that only available for the paid members on the YouTube. So let's start the today's session over here. So kindly please do confirm the audio quality at the earliest so that we can proceed. And further, do let me know if it is working all fine. And if you have not subscribed to our channel yet, do subscribe to our channel at the earliest and press the bell notification icon so that you get updated when we upload the new videos, right? So let's start the session over here, and it's actually related to treasury products. Now I have already explained to you that what is treasury, what are the different roles of treasury, and now we are going to learn about the different treasury products over here. So here is the thing, and further we are going to start with the treasury products over here. So let's have a look at the treasury products first of all. So let's consider about the treasury products. Now, first of all, it's related to that we are going to study about the treasury products in the foreign exchange market. There are so different type of the treasury products. The treasury deals in the different markets. I've already conveyed the idea to you. It deals in securities market. It deals in capital market. It deals in securities and equities, and further also deals in the money market over there. So we are going to cover each and every product related to a treasury. So first of all, it's related to the foreign exchange market, the products of foreign exchange market, and the first one in this scenario is a spot trade. Now, spot trades are particularly those trades where the settlement is on T plus 2 days basis. Like the settlement is on 2 T plus 2 days basis. Like the deal was there on 21st, and there will be gap of particular 2 days, and after that from the working days, particularly the settlement will be there. Let's say it will be on 23rd day over there, and further both the days should be working in this particular scenario, that is 22 and 23 must be working in both the countries over there, both the centers over there, and it is said to be the spot trade. It is said to be the spot trade. And also there is forward trade. There is forward rate in case of the foreign exchange market. Now what do you mean by forward rate? Let's take the case person A wants to buy USD 10,000 from 1 month from now. From 1 month from now, person A wants to purchase the USDs, right? Now the rate will be determined based upon forward rates over there. Now forward rate is actually equal to spot rate. This forward rate is equal to spot rate plus minus premium, plus minus premium or discount, whatsoever the case it will be. So we have already completed the same thing in the module A over there. So we have already explained the things to you that in what case it is added and in what case it is subtracted, right? So let's discuss a case related to it. So let's consider 1 USD over here. 1 USD is equal to 84.38 and 50, right? And for the 1 month forward points are given to be 36 and 40. Now, if we are to calculate 1 month buying rate, if we are to calculate 1 month buying rate, what it will be? Kindly do answer at the earliest. Kindly do answer at the earliest. Now forward rate is actually dealt into by the treasury department over there, and further so as to so as to enter into the forward contracts with customers over there, and further with the banks over there as a counterparties. These all things are done by the treasury. It is being done by the treasury over there. And further, this is actually the forward rate is actually based upon the interest rate differential. It is based upon the spot rate. It is based upon the forward period, and such things are being there. So we have got one answer over here, and further it is given by Madhu Mohan, and it says 84.74. Let's have a look at it. Now the rate on the right side is particularly the selling rate. The rate on the left side is the buying rate over here. So buying rate we were to basically consider, so we'll be considering the spot rate. So this particular rate which is given over here, it is a spot rate. So first of all, we'll be considering the spot rate, that will is 84.38. And also these are the forward buying points and these are the forward selling points over there. And further it says if the selling points are greater than the buying forward points, the currency is said to be at premium. The currency is said to be at premium, and whenever the currency is at the premium, in that scenario the forward points are to be added, right? So 0.36, these are to be added, these will be added to the forward spot rate over there, right? So the answer will be 84.74. So absolutely right, the answer given by Madhu Mohan is absolutely right, it is 84.74, right? And after that, product the third product related to the forex, it is the swaps. Now swaps is actually related to what? Let's take the case that you are holding a position and for the having a spot trade in one market. You basically did a spot trade in one market, and simultaneously you booked a forward rate in other market. You booked a forward rate in other market. It may be the case that I have bought 10,000 USDs in spot market and further I have sold 10,000 USDs in the forward market over there so as to earn a profit out of it. That is what that is said to be swap. Now swap may be between the two forward rates, it may be between the two spot rates, it may be between the one leg is spot rate and the other leg is a forward rate. It may be the case, right? So it is particularly said to be swap. And also the interest rate swaps are also there. The interest rate swaps are also there, right? That is, those are the different products we can say related to the forex market, related to forex market. Now the point is related that from where the treasury is going to get the funds, from where the treasury is going to get the funds over. Let's consider that particular fact. What are the different resources of the funds here, right? What are the different resources or funds here? Now it could be related to that there are profits from the treasury operations, that whatsoever the profits from the treasury operations were there, the bank may be having the surplus related to it. And it may also be the case that whatsoever the overseas branches the bank is operating into, there may be profit related to those particular overseas branches, right? And further it could be related to foreign exchange borrowings overseas, that you have borrowed the money overseas, right? It may also be the case. And it may also be the case that you have borrowed the money from the domestic market. And further it could be related to the foreign currency and convertible rupee deposits with the branches. Let's say NRI depositors are particularly having the accounts with the banks over here. So these are the resources from where the treasury will be getting the sources of the foreign currencies. And also whatsoever the money is placed in the EEFC account, that is exchange earner foreign currency accounts, or in the nostro accounts, or particularly rupee funds swapped into the foreign currency over there, those all will be the sources from where the treasury will be getting the foreign exchange. Is that clear? And further, the particular banks are permitted that they can be investing into the foreign exchange surpluses into the global money markets. They can be investing into the global money market. So banks are also permitted that they can be investing in global money markets, right? So now let's consider what are the different avenues available. Now let's consider what are the different other avenues available where the surplus can be invested, where the surplus can be invested. First one, it's related to the interbank loans. Like bank A is having the surplus and for the bank A require the funds, so interbank lending can be done, interbank loans can be given. And for the short term investment, banks also can be done. Short term investments, we are talking about the short term investments over there, if that can be done, like the banks can be investing in treasury bills, they can be particularly investing in the gilts which are issued by the foreign governments over there, or the commercial papers which are being issued by the foreign companies over there, and this can be done, right? So the board level approval is required for such kind of investment, which is particularly for short term period. And also it could be the case that the bank may be having the surplus balances which is placed under the nostro accounts. Now what is nostro account? Let's take the case, bank XYZ is over here, the bank XYZ is over here, which is an Indian bank. And further here we are having a bank in USA which is a PQR bank, right? Which is a correspondent bank of XYZ bank over here, which is a correspondent bank of the XYZ bank over here. Now, particularly XYZ Bank opened an account. It basically opened an account with a PQR bank in foreign currency. In foreign currency. Now that particular bank account will be the Nostro account for the, it will be the Nostro account for the XYZ bank over here. Is that clear? So that is a Nostro account. So whatsoever the balance is, that is a floating balance is there in the Nostro account. Many correspondent banks do allow that the like we have got this sweep facility in our accounts. The Nostro bank accounts do allow that particularly the amount above one particular threshold will be invested at some other sources where the bank can be earning the money out of it, right? So that can also be there. So that can also be there. So these are the different avenues where the amount can be invested into, right? Now let's talk about, is treasury directly involved into loans and advances? Let's learn the fact that is treasury involved in loans and advances, like, because treasury, I'm just telling you, that is not directly related to the loans and advances, is particularly not involved in the loans and advances if we talk about. But what are the foreign currency loans which are being sanctioned by the bank? Let's say case ABC Bank is here. ABC Bank is here because the banks do allow the foreign currency loans to the customers also. The foreign currency loans are being sanctioned to the customer, whether it is, let's say, the pre-shipment credit or the post-shipment credit. These loans may be sanctioned by the bank. These loans may be sanctioned by the banks, and also the different type of facilities are being given to the gold card holder, or some other facility to the exporters are being given in the foreign currency over there, or foreign currency bills are also being discounted by the banks over there. So for all those cases, the approval is to be taken from whom? The approval, the bank is to take the approval first of all. The loan department is to take the approval from the treasury department first of all. So the approval is to be taken from the treasury department first of all. Only after that the particular loan can be sanctioned in the foreign currency, because the treasury is to look into it whether the particular sources are available properly with the bank over there or not, right? And further, if you are liking this particular video so far, if you have learned the concept so far, kindly please do give this video a thumbs up, and do share this video among your friends and colleagues who are preparing for CAIIB 2024, right? Now, after that, it's related to the other facility which is particularly being given by the Treasury Department, that's related to the rediscounting of the foreign bills. It's related to the rediscounting of foreign bills. Now, what do you mean by rediscounting of the foreign bills? Let's say the case that here we are having an exporter and here we are having an importer. Let's say importer is in other country, let's say in USA, and exporter is here in India, right? And for the exporter has sold the particular goods to a person I, that is the importer, and for the person I has not paid the money, so it has basically drawn a bill over there. Person I has accepted the bill, and further now this bill is particularly present which is accepted by I with the exporter over there. Now exporter wants the liquidity. Exporter wanted the liquidity, so exporter presented this particular bill to the XYZ bank. Let's say XYZ bank is here, and it basically presented the bill to the XYZ bank over there, and further got the bill discounted. Let's say case bill was amounting 1 lakh USD. The bill was amounting 1 lakh USD. The bank gave the liquidity to the exporter amounting, let's say, 90,000 USD, right? Because the bill was discounted, 90,000 USD were given on the spot to the person exporter over here. But now the bank is also under the stringent liquidity condition. The bank also want the liquidity with it, and moreover, because the bank is having the counterparty exposure, the bank is to maintain the provisions for the same. The bank is to maintain the capital for the risk weight assets over there, because it's not a small exposure, it's an exposure, it's a foreign exchange exposure over there. So the banks is to maintain the relevant capital which may be quite high, right? So that is the case. So there are two problems. One, it is related to the bank is having no liquidity. The bank is having liquidity issues, and further the bank is to maintain the capital for the risk weight assets that is to be maintained. These are the two issues with the XYZ bank over here. These are the two issues with the XYZ bank over here. Now particularly, let's say XYZ moved to some other institute, let's say other institute, let's say Exim bank over here, or let's say to particular another institute over here, let's say another bank, PQR bank over here. right? Which will be rediscounting this particular bill. Now, PQR will be providing the liquidity to the XYZ. The PQR will be providing the liquidity to the XYZ bank over here, and ultimately this problem of the liquidity is resolved, right? And the other one, because now XYZ has got this bill rediscounted to the other bank, the exposure which was previously a counterparty exposure is now a interbank exposure. The previous exposure was actually lying with the exporter, that is a counterparty, but now it is converted into the interbank exposure, for which the bank is to maintain a very low capital. For which the bank is to now maintain a very low capital. So this is how it is going to help the bank. Is that clear? Is this particular bank part clear to you, right? And further, such kind of advances like the discounting of the foreign bills, these can be ranging from 15 days to 360 days. These can be ranging from 15 days to 360 days, right? So that is the best part. Okay. After that, it's related to, we are going to talk about the money market products. So we have learned all about the foreign exchange products. Now we'll be learning about the money market products. Now, money market is the market where the short term products are being dealt with, right? So we are going to read about the money market product over there. First of all, it's related to the interbank market. It's related to interbank market. When the banks are dealing with each other, it is said to be the interbank market. And for the interbank market is further subdivided into three parts. It is the call money, it is the notice money, and further it is the term money. When the maturity of the instrument is for overnight basis, when the maturity of the instrument is particularly for the overnight basis, it is said to be the call money. When the maturity is particularly ranged from 2 days to 14 days, from 2 days to 14 days, it is a notice money. When the maturity of the instrument is ranging from 15 days to up to 1 year, 15 days up to 1 year, it is a term money. It is a term money, right? That is the difference between the exposures over there, right? The second instrument, or the second thing that we are going to learn about, it's actually related to treasury bills. It's actually related to treasury bills. Now, treasury bills are actually issued by, let's say, government of India. These are being issued by government of India through the Reserve Bank of India, right? Through Reserve Bank of India, these are being issued, and these comes in three different maturities. These are having the maturity, let's say, for 91 days. Second one, it's related to 182 days, not 184, it's 182 days. And the third one, it's related to 364 days. These are the three different maturities where the treasury bill is available into, right? And further, these are having a implied yield. These are not having a expressed yield. These are having a implied yield. That's why these are also said to be zero coupon securities. These are said to be the zero coupon security. What do you mean by zero coupon security? The treasury bills are being issued by way of auction. These are issued by way of auction. Let's say if a treasury bill was issued for rupees 4,50,000, for 4,50,000 with 182 days of the maturity, with a face value of 5 lakh rupees, with a face value of 5 lakh rupees, it basically indicate that investor is to pay rupees 4,50,000, but after a period of 182 days the person will be getting the amount of rupees 5 lakh. Just like in the case of the FDR, the amount mentioned on the FDR, that the principal amount is what? Principal amount is, let's say, rupees 1 lakh, and you'll be earning interest above and over it, right? But in this scenario, you are basically issued the instrument at a discounted price, and further you'll be getting a full price. And you'll be getting a full price. That's a fair value, that's a face value, that's a par value on the maturity of such instrument, right? That's the case related to the implied yield is, right? And prices are determined by the way of auction. I have already conveyed the idea to you. And further, the bank treasury invest in the treasury bills over there, and treasury bills are having a liquid security market too. It's not the case that these are having the primary market only. These are being also dealt in with the secondary market also. The primary market is also there, where the banks directly buy from the Reserve Bank of India, and also the secondary market is there, and also the secondary market is also there. And the treasury bills are issued in the form of electronic format. It's not the case that these are issued in the materialized format. These are issued in the electronic format over there, and these are held in the SGL account, that is a subsidiary general ledger account, that is maintained with the Reserve Bank of India. That is maintained with the Reserve Bank of India, right? Is that clear? So after that, the third instrument that we are going to talk about from the money markets, it's related to the commercial papers. Commercial papers. Now, commercial papers are what? Commercial papers are unsecured money market instruments. Kindly please note down the words. I'm talking, these are unsecured because these are not issued by the government. Treasury bills are issued by the government, so these are secured. But the commercial papers are unsecured money market instrument which are issued in the form of promissory notes. These are issued in the form of promissory note, that the company who basically issues a commercial paper that promises that we will be paying such amount after such particular period over there, that is being promised over there, right? And further, these are also held in demat format. These are held in the demat format, that is a dematerialized format over there. And further, any particular, it can be placed in any depositories which is registered with the SEBI over there. And let me tell you, these are that the commercial papers are regulated by whom? Kindly do answer at the earliest. Commercial papers are regulated by whom? These are regulated by SEBI, Reserve Bank of India, PFRDA or IRDA. Do answer at the earliest. Kindly do answer over here at the earliest. These are being regulated by the Reserve Bank of India. Reserve Bank of India is a regulator. And further, market practices are given by whom? Who prescribes the market practices for the commercial papers? The market practices are given by the FIMDA. FIMMDA. Now, what is FIMDA? It is Fixed Income and Money Market and Derivatives Association of India. Fixed Income and Money Markets Derivative Association of India. That's a particular case over there. And the minimum denomination in case of commercial papers is, the minimum denomination is of rupees 5 lakh, and these are also issued on discount. These are also issued on discount. There is implied yield. There is implied yield in case of the commercial papers, right? And what are the conditions? What are the different conditions? But before that, let me tell you the minimum maturity. The minimum maturity for the commercial paper is 7 days, and maximum up to 12 months. And maximum up to 12 months, right? That is the minimum and the maximum maturity related to the commercial papers, right? And further, who are actually eligible so as to issue the commercial paper? Who can be issuing the commercial papers? Kindly let me know at the earliest. Who can be issuing the commercial papers? Companies which may be including the NBFCs, that is a non-banking financial companies over there, all India financial institutions over there, AIFI we say them to be, right? Those are actually eligible, that they can be issuing the commercial papers if they particularly having the particularly qualifying with the condition that they are having all the facilities which are taken by them as standard facilities. None of the loan which is taken by them is NPA, and also they're having a standard category working capital limit with them. Then particularly they can be sanctioning the commercial papers, right? And also the cooperative unions, government entities, trusts, and further even the LLPs, that is limited liability partnerships, and any other body corporate who are having the particular presence in India, are having the net worth of minimum 100 crore, they can be also be sanctioning the commercial papers. Let me just reiterate you. So the companies, NBFCs, and for the all India financial institutions, cooperative societies, trusts, And for the unions, limited liability partnerships, which are having presence in India and further having a minimum net worth of 100 crores, they can also be sanctioning the commercial papers, right? That's the case is actually required. And further, what is the minimum thing required condition is that standard working capital limit must be there. Standard working capital limit must be there, and all the loans should be in standard category. All loans in standard category, that is required, that is even required over there. And where you are getting issued, where you are issuing the commercial papers amounting 1000 crore or more, right? Let's say case a particular company XYZ is going to issue the commercial papers, right? Other conditions are already qualified, and XYZ company is going to issue the commercial papers over here, and further it is going to issue the commercial papers amounting 1100 crore, right? Now the XYZ company is to get the credit rating from the two credit rating agencies, not from single CRA, but from two credit rating agencies which are basically registered with the SEBI, and the lower credit rating will be considered. Lower credit rating will be considered, and minimum credit rating of A3 is required. Minimum credit rating of A3 is required. So when the particular company is to issue the commercial papers, it is to be looked into. This must be looked into, right? Is that clear? That is a funda related to it. That is a funda related to it. And now the question can be coming like, is loan against the commercial paper can be taken? Is there any kind of loan which can be taken against the commercial paper? So no loan can be taken against the CP. No loan against CP as a security, because it's already representing a debt. It's already representing a debt. So no loan against CP is actually allowed, and buyback is allowed. Let's say case company want to buy back the CP, so buyback is allowed after 30 days of issuance. It is allowed, but after 30 days of issuance only, not before that. You cannot be buying back before the 30 days of issuance, right? So that is actually related to the commercial papers. That's all about the commercial papers. Now after that, we are going to learn about the other instrument of the money market that's related to the certificate of deposits. That's actually the certificate of deposit. If we simply say it to be the CD, that is certificate of deposit, right? Now, certificate of deposit is what? It's a short-term security with a fixed maturity, which is being issued by a bank, right? Now, certificate of security is issued by a bank. That's the first point. It is issued by bank. Now, it is being issued by the bank, so it is secured enough. It is secured enough. So basically, if the bank wants to raise funds in the secondary market, it can be done by way of issuing the certificate of deposits over there. So all scheduled commercial banks, so whatsoever the scheduled commercial banks are there, SCBs are there, RRBs are excluded in this scenario. RRBs are not covered in this scenario. These are excluded over there. And also the local area banks, right? Local area banks, so excluding the RRBs and local area banks, whatsoever the scheduled commercial banks are there, and further also selected all India financial institutions, they can be sanctioning what? They can be sanctioning the certificate of deposits. And who can be the investor? Who can be investing in these certificate of deposits over there? Individuals can invest. Yes, the individual persons can also invest in case of the CDR. Individual persons can be investing, the corporations can also be investing, the different trust funds can also be investing, companies can be investing, associations can be investing. Can NRI invest in particular CDs? Yes, NRI person can also be investing, but there should be non-repatriation basis they can be investing into CDs. That it's not the case that they can be taking the money all back to their home country thereafter. So non-repatriation basis, the CDs can be purchased by the NRIs also. Now let's learn about, are these issued on a discount? As in the case of the commercial paper, yes, these are issued on discount. These are actually issued on discount. These are particularly having the implied yield. And what is the minimum maturity? What is the minimum maturity? The minimum maturity is of 7 days and maximum up to 12 months. Maximum up to 12 months if these CDs are issued by the banks. If these are issued by the banks. But if these are issued by the financial institutions, let me just tell you, if these are issued by the financial institutions, then the maximum maturity can even be up to 36 of the months. If these are issued by the financial institutions. Is that clear? Is this particular point clear over here? And what is the minimum denomination? The minimum issue size is rupees 5 lakh. The minimum issue size in case of this particular CD is 5 lakh here. Is that clear? Kindly do let me know. No loan or no buyback is allowed, and these are also freely transferable. These are also freely transferable. Is that particular thing clear to you? All right. After that, we are going to learn about another particular money market instrument, and that's actually about the repo. That's actually about the repo. Let me just divide the area over here, right? So we are going to learn about the next instrument from the money market, and that is repo. Repo is what? Repo is a repurchase offer. It is a repurchase offer. Now let's say the case bank XYZ is here, and bank XYZ is in need of funds. They do require funds, but XYZ is bank is having surplus of the securities. They are having surplus of securities. Now under a repo transaction, the particular XYZ bank will be keeping these securities with the other counterparty, surplus securities with the other counterparty. Let's say the other counterparty is ABC over there, with a particular contract that it's going to purchase back such securities. Let's say these securities, which are the surplus securities, these will be kept with the other bank over there, counterparty over there, with the commitment that they are going to basically get back these particular securities after a fixed particular period at a fixed predetermined price. So after a fixed period at a fixed particular price, they are going to repurchase such securities. They are going to repurchase such securities, right? That is a case of the repurchase offer. That is a repo over here. And for the repo can be used for the lending and borrowing money market funds, and this can be ranging for a period from 1 day to 1 year. From 1 day to 1 year. So you basically, if you require the funds from ranging from 1 day to 1 year, you can be opting to participate in the repo transactions, right? So the banks who are in need of the funds, who are having the surplus of the securities, they particularly those securities which are eligible for the SLR requirement, that is statutory liquidity ratio requirement over there, they can be entering into repo transaction. They can be keeping their surplus securities with the bank over there with the commitment that they are going to repurchase those particular securities after a fixed particular time period over there at a fixed particular predetermined price over there. That is said to be the repo transactions. And mutual funds and corporates are also now allowed, right? So now the mutual funds and further corporates are also allowed to participate. These are now allowed, that they can be participating, in the repo transactions now. Is that clear? Is this particular part clear over there? And further, if we compare the interest rates, if we do compare the interest rates of money market, general money market, with the repo transactions over there, which particular transactions will be having the lower interest rate? Definitely the repo rate transactions are lower interest rates. These are having the lower interest rate. Why? Because security is available in case of the repo transactions. because the security is available in case of the repo transactions. And let's say case bank XYZ required 100 crores of the funds, 100 crore of the funds. Then in that particular scenario, XYZ bank will be keeping, let's say, 105 crores worth of the securities. Why? Because 5% will be kept as margin. 5% will be kept as margin. Surplus securities will be taken by the other counterparty over there. Is that clear? So that's actually related to the repo transaction. That's actually related to the repo transaction. Now, this repo transaction is also used under the LAF. This repo transaction is also used under the LAF. That is what? LAF is liquidity adjustment facility. LAF is what? LAF is liquidity adjustment facility, that whensoever the Reserve Bank of India wants to manage the liquidity in the economy, it basically do play with the repo. It do play with the repo over there, and particularly repo is extensively used by the Reserve Bank of India so as to basically use an instrument for monetary control. So RBI, we can simply be writing that RBI uses repo for monetary control. For monetary control, the RBI make use of the repo. Let's say the case when there is shortage of funds, when there is shortage of funds in the market, when there is shortage of funds in the market, the banks and the primary dealers, they can be selling the government securities to the Reserve Bank of India, right? So let me just tell you, if there is shortage of funds, in that scenario, what will happen? Banks and primary dealers, they will sell securities. They will keep securities or they will sell securities to RBI so that the money will flow into the market. And further, when there are excess funds or when the banks are having surplus liquidity, in the case of surplus liquidity, the opposite will happen. That is, the reverse repo transaction will be there. In case of the surplus liquidity, funds in excess of the demand in the money market, funds in the excess of demand in the money market over there, they can buy securities from the Reserve Bank of India. They can buy the securities from the Reserve Bank of India. That's the case, right? Now, after that, we are going to learn about the CBLO. After that, it's about the CBLO. Now, CBLO is actually what? CBLO is collateralized borrowing and lending obligation. It is as simple as that. Collateralized borrowing and lending obligation. Very much easier, but very much important instrument. Let's understand this one. Now, CBL is actually a money market instrument which is issued by whom? This is issued by CCIL. CCIL was is CCL is what? It is Clearing Corporation of India Limited. It is Clearing Corporation of India Limited. And for the CBLO is a repo instrument. It's a repo instrument. But in this particular scenario, there will be no counterparty risk. Whenever in any of the transaction, two parties are dealing with each other, there is always existing the counterparty risk that any of the two parties can particularly be failing in completing their obligation. But in case of CBLO, there is no counterparty risk. Why? Because CCIL will be working as exchange. CCIL will be working as intermediary. It will be working as an intermediary. So the persons who are having the excess of funds, they will be on the one side, who are having surplus funds, and the institutions or persons who are having excess of securities, or let's say surplus securities, those will be on the other side, who basically do require funds. They will be keeping their securities with the CCIL, and for the CCIL will be meeting up the demands, and for the no one will be knowing that who has basically purchased the securities or who has sold the securities over there, only demand and supply will be fulfilled. So that is actually the CBLO. And for the term of CBLO is ranging from 1 day to 1 year, as in the case of, because it's a money market instrument, so the particularly maturity will be ranging from 1 day to 1 year. And as I told you, CCIL will be acting as an intermediary over there, and CBLO is also having an active secondary market. There is a active secondary market that is existing in case of the CBLO over here. Is that clear? Is that particularly clear over there? Right? And further, they can also be prepay the amount. They can also be prepay the amount, or by purchasing the CBL in the market out there. That's also allowed over there. And all the transactions are done through CCIL. So whatsoever the transactions are there, those are done by through the CCIL over here. Right? That is a CBLO. That is a collateralized borrowing and lending obligation. Okay. After that, it's related to the bill rediscounting. After that, it's actually related to the bill rediscounting. I've already given an idea related to bill rediscounting in the case of foreign exchange market, but it's actually related to money market now. It's actually related to money market now. So Treasury will discount the bill of exchange for short-term nature, like the bill of exchange, those particular bill of exchange which are ranging with a maturity, residual maturity of 3 months to 6 months. Those are being rediscounted by the Treasury, right? Those are rediscounted by the Treasury over there. And for the purchasing bank is also having the benefit, the selling bank is also having the benefit, because the interbank bank exposure is there. So the risk is quite lesser in this scenario. So the risk is quite lesser in this scenario. So I'm not going to repeat it again, right? Now after that, we are going to learn about the securities market. Now we have already learned about the money markets. Now we'll be learning about the securities market, the instruments in the securities market. Right? Now, first of all, the Treasury do deal with the government securities. Whatsoever the government securities which are being issued by the government over there, which are basically eligible for complying with the SLR. So these basically comply with the securities, comply with SLR requirements, statutory liquidity ratio requirements over there. So the banks who are basically SCBs, that is a scheduled commercial banks, they are to maintain the SLR, a fixed percentage of NDTL, that is a net demand time liabilities, to be maintained in the form of SLR, and this can be maximum up to 50%. No, sorry, maximum up to 40%. So SLR can be maximum up to 40%. And right now the current SLR is what? Current it is 18%. Currently the SLR is to be maintained at 18% over there. It means for every 100 rupee of the deposits, the bank is to maintain 18 rupees in the form of the securities, in the form of securities or in the form of cash, whatsoever it is, right? So it's basically like that. Is that clear? So SLR requirement is particularly there. It can be purchasing the bonds from the SIDB or from the NABARD, or the priority sector bonds can be purchased over there. And government securities are issued by whom? These are issued by PDO. PDO, that is Public Debt Office of Reserve Bank of India. It is a public debt office of the Reserve Bank of India on behalf of Government of India. On behalf of whom? On behalf of the Karta Dharta, that is Government of India. Basically, Reserve Bank of India issues on the behalf of particular Reserve Bank of India issues on behalf of the Government of India. And for the further, and for the government securities are issued through auctions. These are issued through auctions, right? And under the retail direct scheme, under the RDS, individuals can now also be participating in purchasing and purchasing of the government securities in the primary market, right? So that can also be done through over there. So that can also be done. So RBI can be absorbing the liquidity. So the how it is particularly being used, let's say there is excess of liquidity, there is excess of liquidity. Now in that scenario, if there is excess of liquidity, RBI will be doing what? RBI will issue securities. RBI will issue the securities. That will be done. Because when the RBI will be issuing the securities, there will be investors. who will be investing into this, and further the money will be sucked out of the system. The money will be absorbed from the system over there. And when particularly there is excess lesser liquidity, the RBI will be particularly doing what? RBI will be buying back the securities. So we can say when lesser liquidity, when lesser liquidity is there, RBI will be doing what? RBI will buy back, right? So that money can be infused back into the market. Is that clear? So that's the main funda related to it. I hope that you are clear with it the same. Kindly please do let me know at the earliest. And further, RBI has particularly issued the bonds of different maturities, the government securities, which are ranging with the maturity of 1 year to 30 years. So these are long-term securities. These can be having the maturities up to 30 years over there. Is that clear? After that, we are going to learn about, after that, we are going to learn about the money market, sorry, we are going to learn about the corporate debt paper. It's about the corporate debt paper, right? Now, what do you mean by corporate debt paper? Corporate debt paper means medium and long-term bonds. What does it indicate? It basically indicate medium and long-term bonds, which are particularly issued by the corporates, right? So these are issued by whom? These are issued by corporates, by financial institutions, right? These are not issued by the government of India, right? These are particularly issued by the corporates. These are basically issued by the financial institutions, but not by the government of India. And these are also referred to as non-SLR securities. These are not eligible for the SLR purposes. These are primarily the banks do invest in such kind of securities just for investment purposes, right? That's the main thing related to it. And tier 2 capital bonds, which are basically issued by banks. If I'm just giving an example over here, so tier 2 particular capital bonds, which are issued by the bank, those also fall in the same category. Those also fall in the same category over there, right? So I'm just writing same category of the commercial debt paper over there. Is that clear? Now, the yield will be somewhat higher. Now, yield will be somewhat higher if we compare it with the government bonds over there. If you're comparing them with the government bonds, definitely the yield will be higher because they are somewhat, you can say, somewhat unsecure. And further, they are having a fairly active secondary market too. Yield is quite higher over there. And further, those are issued in the demat format over there. That's particularly the case related to it, right? After that, it's related to the next one. We are going to talk about the debentures and bonds. It's related to the debentures and bonds. Now, what is the difference between the debentures and bonds? Both are what? First of all, both are the debt instruments. Both of these are debt instruments. They basically acknowledge the debt. Let's say if company has issued the debentures, it's basically indicating that it's basically acknowledges the debt of the company over there, right? But let me just tell you, bonds are issued by the public sector companies. So if we talk about the same, bonds are issued by whom? Bonds are taken by the issued by the public sector companies. Now, whatsoever the public sector companies are there, they will be issuing the bonds over there. And if we talk about the debentures, those are issued by the private sector. Those are issued by the private sector companies here, right? So that is the funda over here. That is the funda over here. Is that clear? And for the bonds are negotiable instruments which are governed by the contract laws over there. Contract laws basically govern the same. And the debentures which are being issued, the debentures which are being issued over there, or the bonds which are being issued over there, these can be convertible or these can be non-convertible. Both of them. These can be convertible if these are convertible into equity component, or right, then these are said to be convertible, or particularly these can be non-convertible, that these cannot be converted into the equity format over there. Now why these will be beneficial? If these are convertible, how come these would be beneficial? Let's say the case, if the bonds or debentures are convertible, in this scenario the company is not to repay the amount, because the debt is to be repaid but the equity is not to be repaid. The company is not to repay the amount. That's the benefit to the company, right? And further, the investor is going to execute the option for the conversion only if the equity price would be higher than the redemption price of the bond, right? So definitely the bond holder or debenture holder is also going to be benefited, right? So that is the scenario. So that is the case related to it. Is that clear? So it basically is having the two types, that one is related to convertible and further it's related to non-convertible bonds over there. And also zero coupon bonds are what bonds? Let's say the case company XYZ is over here, and company XYZ actually issued 1000 rupees 5-year bond with 8% of the coupon. Now what does it indicate? That the person who will be investing into this particular bond is going to earn rupees 8 rupees 80 every year as a coupon for 5 years. The person who is going to invest is going to earn 80 rupees as a coupon amount over there, and on the maturity after 5 years the person will be getting 1000 rupees back. That is particularly what it is indicating, right? But in the case of the zero coupon bond, the bonds are issued on a discount. Let's say there is a zero coupon bond for 5 years, there will be no coupon that will be paid. 1 2 3 4 5 1000 rupees bond was purchased for, let's say, 850 rupees over here, that it was available on a discount, and on the maturity the person will be getting 1000 rupees over there. That's the implied yield will be there, as in the case of the treasury bills we have already read about. In the case of commercial papers and certificate deposits we have already read about. Is that clear? Okay, so that will be all about this particular video, and further I hope that you must have enjoyed the content of this particular video, and rest topics we will be covering in the next video. So do like the video at the earliest, and further do share the video among your friends and colleagues who are preparing for the CIIB 2024. And if you want to get the PDF of this particular file, you should be joining our WhatsApp group right now. You should be WhatsApping, writing CIIB group, and WhatsApp it to the number 83609444207, and we will be adding you to our particular CIIB group. And the CIIB crash course is also available, where you'll be getting complete crash course videos, chapter wise previous questions, mock test, mega mock test, case studies, everything over there, which you can be covering in a very limited span of time. So if you want to join the crash course at just rupees 1699 on the particular auspicious perf of Guru Perf, so you can be joining at just rupees 1599 just for tomorrow. You need to WhatsApp CAIIB 1599, where you'll be getting all the 5 papers, that is all the 9 papers of the CIIB for 1 month. You'll be getting it for 2 months of the validity in just 1599. The offer is valid just for tomorrow for the viewers only, right? So that will be all. Thank you so much, and see you again in the next video tomorrow.